Hi everyone, this is the second part of the two price action videos. If you recall, in the first one I looked at price rejection, supply and demand consumption, compression and liquidity spikes. And this one's more looking at the basics of chart patterns and bar patterns. Okay, so I'm going to be looking at continuation and reversal chart and bar patterns. Okay, now this isn't an exhaustive list of all the chart and bar patterns out there. This is just a small list of the patterns that I use personally in my trading, the ones that I think are more reliable over other patterns. Okay, so first looking at continuation chart patterns, the bull and the bear flag. Okay, now these are very popular patterns, the flags, and they're something I use quite routinely in my trading on multiple time frames. Okay, so what is a bull flag? A bull flag is basically you have a strong trend, okay, and that resembles the pole. We have a pullback within that trend, which is obviously a period of consolidation, and it happens to be, you know, sort of the 90 degrees kind of angle, which forms the flag-like pattern, hence why it's called a bull flag. What is happening in a bull flag? Well, we have the strong trend, price is pausing and retracing, and in doing that retracing, it is consuming supply. Okay, if you remember from the previous video, we talked about demand and supply consumption. As it is dipping to find demand, and it is consuming supply in the process. So as you can see clearly here, we are dipping, we are consuming supply. We dip until we meet demand at a support resistance zone, and therefore the path is cleared to pave the way higher in the direction of the initial strong trend. Okay, so it's just another pattern like the compression or the supply demand consumption patterns that we spoke about in the previous video. Okay, but this is just a specific pattern that highlights the price action that is occurring. Okay, so obviously the reverse situation, a bear flag, we have a strong downtrend. We consolidate as price moves up. We are consuming demand this time. It moves up and again until we see a clear support resistance area, which is obviously where supply is, and therefore the path has been cleared to pave the way for price to move down in the direction of the strong trend. Okay, so whenever we're looking at these patterns, we're looking at what is the price action within the pattern. Okay, so that is the consumption of supply or demand, and looking at where to expect the continuation pattern to occur. So in the case of a bear flag, it's always going to be, we're looking for where do we expect this price to meet supply and for this pattern to work out. Okay, a lot of people that trade patterns and bars, in my opinion, don't have the fundamental knowledge of why these patterns work, and therefore don't know what to be looking for. Okay, yeah, I think it's probably 9 times out of 10 people won't know what a bear flag is in terms of why it works, in terms of demand, supply, consumption, and how to properly and efficiently trade it. Okay, which isn't really a topic for this video. It's more of a understanding what patterns I use and what I'm looking for and why they work. Okay, so these are obviously both continuation patterns. They work on multiple time frames, and I'm looking for strong trends in terms of, you know, a picture perfect flag. You know, the bull flag. This one here was a, you know, textbook picture. They won't all appear is you know, you're not looking for necessarily the picture perfect. We're looking at what is happening within it. You know, can we realistically say we have supply consumption going on here? Can we identify an area, a support resistance zone where we can expect demand to come into the market and price to move high and break this pattern and continue the trend? That's what we're looking for. We're not looking at, well, this doesn't quite line up, it's not quite flag like. You know, this could be a pennant or more of a wedge-like wedge-like picture. It's more what's happening within the pattern itself. Okay, the price action itself. The chart pattern is not the price action, it's what's happened within it. That's the price action. Okay, the demand, supply, consumption. That's very important, and it's not commonly understood. Okay, people trade mechanically when it comes to price action patterns, chart patterns and bar patterns, without really understanding what's going on and what to look for. Okay, so the next continuation pattern, ascending and descending triangles. Okay, so what's happening here? Well, we can see an ascending triangle is basically where we have a flat line and then the ascending line being the triangle. Okay, so we can see the triangle. It should be pretty clear what's happening here. We're having bulls overcoming bears essentially. Each rejection away from the support resistance zone is getting weaker, which obviously suggests more buyers overcoming sellers, bulls overcoming bears, until we get the breakout, okay? And of course we expect a good breakout because this is building pressure at this support resistance zone. We know what happens on a breakout in terms of the rush that happens and why. We know that from my order flow video. But this is essentially what's happening in an ascending triangle, okay? We're having weaker rejections of a resistance zone, okay? And for my first video on supply and demand, what do we know about support resistance zones and supply demand when we have more touches of it? Okay, it's getting weaker. The available supply at this resistance zone is getting weaker as we have more touches, okay? And because it's happening in this ascending triangle pattern, we can basically see that weakness, okay? Each rejection is getting weaker. Demand is starting to consume supply and overcome the supply, until we get to a point where there is no available supply left and price breaks out, okay? The buying pressure overcomes the available selling pressure at this area, okay? And conversely, for a descending triangle, so yeah, the same thing happens again. We're hitting support zone, weaker rejections, demand getting consumed, supply becomes that demand, and we continue lower, okay? It's a bit misleading this because it looks like it's actually a reversal pattern, but it actually came from up there and paused and came back a bit, okay? But these are generally continuation patterns, okay? Okay, so they are the two main continuation patterns I'm looking for in the market: the bull, the bear flag, and the ascending descending triangle, okay? Again, they don't need to be picture perfect. It's more about understanding what's going on and why, and interpreting how to use that information to determine where you expect the supply and demand to come into the market to break that pattern and for the continuation move to occur, okay? Remember, professional price action traders are looking to end trades at the source of the move, okay? If the probability suggests that, then they're looking to enter at the source where possible, okay? Trading is all about understanding probabilities and adjusting your risk accordingly, okay? So now we're moving on to reversal patterns, okay? And the first one being the double top. And it should be very clear if you've watched my supply and demand videos why a double top happens, in terms of this area here is essentially a supply demand turning point. Remember, we talked about supply and demand zones and turning points at swing highs, swing lows. This is a turning point, okay, isn't it? We've got, within this we'll have a supply zone, a lower time frame supply zone. So when we come back here, we can try and pinpoint. Remember my video where I was pinpointing supply demand zones within support resistance zones? We can pinpoint where the decision was made within here to move lower, to determine where we expect supply to come back into the market here. It's a first time back essentially, okay? That's all a double top pattern and double bottom pattern is, okay? It's a first time back to a previous supply demand zone. When do they work best? Well, when you've had a big imbalance coming out of the initial supply demand zone, okay? Remember, talked about breakouts and good momentum breakouts suggesting a big supply demand imbalance. That's exactly what's happening in a double top. Okay, we're coming back to the source of the initial supply demand imbalance. Okay, so that's all a double top pattern is. Okay, and obviously it is essentially reversing the trend leading into the top. Okay, that's why it's a reversal pattern. And conversely, when we look at double bottom, the same thing. We have the big breakout, so we know there's a big supply demand imbalance here. We come back to it for the first time, we can identify where that is, and we get a reversal of the move back down into it, okay? The next reversal pattern is one we've already looked at. When we looked at in the video, the last video, in terms of compression and supply demand consumption, if you remember, we looked at patterns like this, okay? This is compression of price, okay? It's a reversal pattern, which I've been over, but I've just included examples here for completeness. Price compresses, we have a wedge-like pattern. I call it converging wedge. So price is getting squeezed here, okay? And of course, it's getting squeezed until demand overcomes supply, and typically at a previous supply demand zone or support resistance zone, and then the path has been paved way for price to move higher, okay? We're always looking for that good breakout. If this pattern is holding true in terms of the price action that's happening, the breakout should be high momentum compared to the consolidation that has occurred, okay? It's important to understand when price action trading what we expect price to do and why, okay? Because that allows us to view price action objectively and to understand if price isn't moving how we expect it, we can look to reduce our risk or cut our trade. And if it is, then obviously that's confirmation that price is doing exactly as we expect, and then we can use that to our advantage in terms of trade management. Okay. So this is obviously a bullish reversal wedge, and conversely we have a bearish reversal wedge, the same thing happening. Again, these will look different in terms of, we could have ascending, descending triangles. They won't all look the same. It's more about what's happening within the pattern. Okay, the pattern is just the easiest way to identify what most likely is happening. It's understanding what is happening within that pattern that gives us the edge in terms of knowing what we expect price to do, and therefore being able to trade that accordingly. Okay, so again, we are converging, we have compression, we are consuming demand until we meet supply, and again we have the big breakout relative to the consolidation that's happening and the good momentum move back down. Okay, so just recapping, it's very important to understand patterns are just a way of visually be able to quickly identify what is potentially the price action that is potentially happening. The chart pattern isn't the price action, it's what's happening within the price action. Okay, a lot of people in a lot of textbooks and public forums, you'll see a list of price action patterns, but you'll never see why the pattern works and what to look for. That's why you get people that trade things mechanically, and they're saying, well, I'm waiting for the breakout of this pattern, therefore I have confirmation that the breakouts work, and then I'll look for another pattern within that to look for a high probability trade to enter lower. And by the time you're looking to enter, you're looking to enter way past the initial source of the supply. If you can identify say a support resistance zone up here or supply demand zone, then you've got a reason to enter at the source. The pattern suggests a bearish move. You're coming up to you're at a proven supply zone. That's where you look to enter trades like this. Okay, and you base your risk on the probabilities in place, okay, of what the pattern and what the price action suggests. You don't think, well, I've got this pattern, I want to wait for the breakout because that gives me good confirmation that the pattern is true. Then I'll wait for a retest or a bar pattern coming down here. Then I'll look to get a thing with my stop loss up here. That's not professional price action trading. That's amateurish. It's novice trading. You don't make money trading in a market like that. You make money by understanding the pure price action that is going on behind the scenes within the patterns, and basing your risk on the probabilities involved. Okay, so you look to get into the source, then you get the breakout, you're looking to enter again on the breakout. You're looking to add positions as price moves in your favor. Okay, it's important you add positions as price moves in your favor. As price proves that you are correct and the pattern is working out, you look to increase your risk. You will look to increase your exposure. Why would you not? Okay, how do we know this pattern is working out? Because of the breakout, the rejection at what would have been a proven supply zone, the good momentum breakout. That shows us that's how we expect the price to move, isn't it? So therefore, that gives us confidence that what is happening behind the scenes in terms of demand consumption is true. Okay, so that gives us more confidence and a high probability of price continuing down. So we look for reasons to enter more exposure after having traded, started our positions here. Okay, just an insight in terms of the mindset I think is needed and is often lacking in the retail space when it comes to trading price action in terms of chart patterns and bar patterns. Okay, so this next reversal pattern, okay, so this is the third reversal pattern, is the Quasimodo. This is an uncommon pattern. Not uncommon in terms of it doesn't happen often in the market, it's just uncommon in terms of it's not commonly used. You don't see it in many textbooks or many threads on public forums. Okay, it's a reversal pattern, and for a bullish Quasimodo, what we're looking for is a low, a high, a new lower low, a new higher high, and then price coming back to the vicinity of the original low, where we expect it to be met with demand, and therefore that's reversal. That's the trigger to go long. Okay, so low, high, lower low, higher high, back to the vicinity. Okay, it's not, well, it's got to line up as with all price actions patterns. It's not being mechanical. You're not saying, well, it's got to line up here and only go long here. You're looking at where will demand come into the market. We can see in this case we here this little area here on the very low time frames. You can see this is the obvious place to expect the demand to occur. So this would be the long trigger. Okay, this is where we expect the reversal pattern to work out. Okay, this pattern happens on all time frames. I particularly like it on the very low time frames, especially when you're zooming into a support resistance zone or supply demand zone and looking at the 1-5. Yes, the 1 minute time frame is reliable, despite what most people will tell you otherwise. The 1-5, 15-minute time frames, I very much like this pattern at support resistance zones. Looking at this gives you the confirmation that gives you a high probability when you're not quite sure in terms of you don't have it's not like the first time back to a support resistance zone, for example. You're looking at a third time back, you're not quite sure, we don't have anything in information to determine what's going to happen out that area, so therefore we're looking for potential patterns and price action. Okay, so this is a very good reversal pattern on the very low time frames, in my opinion, when looking at higher time frame support resistance. Okay, so for a short one, it's the opposite. We're looking for a high, a low, a new higher high, a new lower low, and then coming back to the vicinity of the original high. Okay, and again, you can see, looking through here, you can see this is support resistance zone. This is where we expect the supply to come into the market. Okay, now they won't all, again, like all price action patterns, they won't all line up perfectly. Sometimes they'll be slanted a bit more, it won't come up exactly to here, but there should be an obvious place where you can identify where the supply should come into the market. Okay, jumped ahead a bit too much. So that concludes chart patterns. Okay, so I've looked at the bull, the bear flag. I'll just go back quickly. Looked at the bull flag, the bear flag as continuation patterns, the ascending, the descending triangle as continuation patterns. I looked at the double top, the double bottom as reversal patterns, and I've looked at the converging wedge, which is essentially the compression and supply demand consumption that we spoke about in the previous video as reversal patterns, and I've looked at the Quasimodo as reversal pattern. Okay, so now I'm looking at bar patterns. Okay, now I look at two types of bar patterns. I prefer chart patterns over bar patterns most of the time. Bar patterns I like to use are the bullish outside bar, the bearish outside bar, and the pin bar. I don't use any other bar patterns in my trading. These two I think are reliable signs of what is happening most likely to happen next to price. Okay, so the bullish outside bar is an engulfing bar. You're looking at the bar to engulf the previous bar. Okay, ideally you're looking for the low and the close to be near the extremes of the bar. Okay, we're certainly not looking at it to be in the middle, because that would be more like a doji bar. We're looking at it to be nearer the extremes, certainly in the the upper 2/3 and the lower third. Again, it's not mechanical science here. Well, it doesn't quite fit in the lower third. You have to use common sense as to what the bar is telling you, not mechanics. Okay, it's not trading isn't mechanical. It's using common sense, being objective. Okay, this bar completely engulfs the previous 3 bars. It is at a support zone. What does this tell us about price? It's a reversal pattern. Okay, it's a reversal bar pattern. Okay, it's telling us price is most likely to head up higher. Okay, bullish outside bars and bearish outside bars can be continuation patterns and reversal patterns. I prefer them as reversal patterns. Okay, so in this case the trend is down into a support zone. We have the bullish outside bar, which engulfs the previous 3 bars. It's a close in the upper 2/3, an open near the bottom 2/3. This is telling us that price is most likely to head higher now. Reverse the trend. Okay. The other way to see it is if we had a bearish outside bar here, or say we had, we were up here and we saw a bullish outside bar, say here, engulfing this green bar here, coming down here, engulfing up there. That would be a sign that price would be continuing in the underlying trend direction. Okay, I don't like that so much. I don't like to enter high up in a trend and continue that trend. I prefer reversals, so I'm looking to use these as reversal patterns. Okay, and again, just like chart patterns, bar patterns are not price action themselves. Okay, this is a very misunderstood things on public forums in the retail space. This whole thing of using candlestick bars is very popular on public forums in particular, and certainly grown exponentially over the last 4 to 5 years. But it's taught in the wrong way, as far as I'm concerned, completely taught in the wrong way. Okay, a bullish outside bar is merely a sign of where price is going to go. It's a culmination of the price action that has happened at this support resistance zone. Okay, the bar itself is not price action. Price action is what occurred here that caused the bar. The bar is essentially the same as a lagging indicator. Okay, it tells us what happened here. but it's also forward-looking, just like lagging indicators are. They have forward-looking ability, and it tells us what is most likely to happen next. Price moves up to the resistance zone, okay, the previous supply zone up here. Okay, so moving on, opposite of a bullish outside bar is a bearish outside bar. Open close within the high and low 2/3 of the bar, completely engulfs the previous bar. We are at a resistance zone. We're reversing this trend here, so this suggests price is moving down. Okay, it is a result of the price action occurred at this support resistance zone, which obviously inside that zone has a supply demand zone or supply zone, a lower time frame supply zone. So it is a culmination of the price action that has occurred here. It's a lagging indicator. Okay, is a result of the price action, but it was forward looking as well, just like all lagging indicators are. They have forward looking ability to a certain extent, and it tells us what is most likely to happen to price. But it's important to note that these bar patterns are not price action. They're the result of price action that has occurred. Okay, and if possible, we are not looking to wait for confirmation of these bars. We're looking to enter at the source of the move, or the supply-demand imbalance, okay? But there are times where we don't have enough information to conclude with good probability of what is going to happen at support resistance area or supply-demand zone. So therefore, we look for chart patterns, we look for bar patterns to give us that information we require in terms so we have the probabilities in our favor enough to want to risk a position on a trade, okay? So that's the important distinction to have, okay? We're looking at support resistance, we're looking at supply demand zones. We're using the order flow dynamics that we know to identify trade setups, okay? There are times where we don't have enough information to take a trade, so therefore we're looking for further confirmation, and we get that from price action, okay? The compression, the supply demand consumption, the rejection, the liquidity spikes I spoke about, the chart patterns, which show what's happening in terms of supply demand consumption and compression as well. And then we have reversal bar patterns as well, okay? But this is only when we don't have enough information to take a trade at the source, okay? It gives us a bias, okay? I might have gone over that a bit too quickly, but it's important to try and understand the mindset, thinking about things the right way in terms of what is price action, what is not price action, what bar and chart patterns actually are, in terms of what is going on behind the scenes and what that means going forward in terms of predicting where price will move. Okay, so the last bar pattern is the pin bar. Okay, a pin bar is essentially, we have a wick and we have the open and close within the upper third of the bar high for a bullish bar. Okay, so we have, it's like a pin bar short for a Pinocchio bar. It's a reversal pattern. It's basically, we've had the rejection of a support zone, and we've closed. We have the open and close within the upper third of the bar. Okay, that's for a bullish one. It will be the opposite for a bearish pin bar, which I'll show in a minute. Okay, that's all a pin bar is. It shows a rejection of price at a support resistance zone, and we are and with the open and close in the upper third. Okay, so that's all that's happening in a pin bar. It's a quick rejection within that time period. Okay, and again, it's lagging because it's the result of the price action that has occurred here, but it's forward looking is in terms of, because we've had that rejection, it tells us that price is more likely to move higher than it is to move lower. Okay, that's all it does. That's all it tells us. Okay, it's a result of price action. It tells us where price is most likely to go, in which direction price is most likely to go next. Okay, and I'll see the bearish pin. Same thing. We have a resistance zone. Price rejects that resistance zone. We have a big rejection, a big spike, and we close with open and close within the lower third of that bar. Okay, that tells us the price is more likely to be heading down than it is to break out of that resistance zone. Okay, it's a result of price action that occurred here. Therefore, it's lagging because it's after the event, but it's forward-looking in terms of it gives us confirmation or gives us information, the direction in which price is more likely to happen next. Okay. Okay, everyone. Well, that concludes my educational videos. I hope they were useful. It's very much, not talking about trading strategies, just talking about the basics, the fundamental knowledge that is required in order to start devising and understanding price action trading strategies. Okay, it's some of the basic knowledge, of course, is some of the advanced stuff I'll say for my trading room members. But it's important to have this knowledge: supply, demand, support, resistance, the distinction between the two, which some of you might find surprising. Most people don't know that distinction. They think they are the same thing. Um, price action in terms of compression, liquidity spikes, supply, demand, consumption, rejection, and patterns that indicate that price action I spoke about in the first video is happening. Okay, and the same with bar patterns. Okay,